We often hear in the news about rising unemployment, increasing inflation, and the financial challenges many people are facing. Yet, the stock market continues to reach record highs, leaving some people wondering, is a recession on the horizon? If it does, are you ready for it? In this video, we will analyze what Warren Buffett did over the years when facing recession and review a study from Charles Schwab on various investment strategies. At the end, we will break down 4 key approaches to help you safeguard your finances if a recession does occur. Let's get started. In the second quarter of 2024, Warren Buffett made significant changes to Berkshire Hathaway's portfolio, including a huge reduction of over 389 million shares of Apple and a full exit from positions in Snowflake and Paramount Global. Looking back to the second quarter of 2023, Apple made up 51% of his portfolio. Now it has reduced to 30%, but it is still the largest position in his portfolio. This marks the 3rd consecutive quarter Buffett has sold Apple shares. Overall, Buffett sold over $77 billion worth of stocks in this quarter. This figure has surpassed any amount he has ever sold in a single year. Following these moves, Berkshire Hathaway's cash reserve swelled to $277 billion, up from $189 billion in the first quarter of 2024. What is Buffett trying to do? Did he see something that we as individual investors did not see? So far, he said selling stocks is for tax purposes. Well, there is no clear answer why he sold that much stock at the moment. Since we cannot find any solid answers, let's take a look at Buffett's past performance to better understand his approach. Between 1970 and 1974, the stock market experienced 2 crashes. The first one was in 1970. The U.S. was mired in the Vietnam War with no clear resolution to end the war, while domestically, inflation was surging. These factors weighed heavily on the economy, causing the stock market to plunge by 36%. However, it bounced back very soon afterward. It was a V-shaped recovery. Everything looked perfect at the time. In 1972 and 1973, the stock market did very well and even better than 1970. In 1973, the U.S. was hit by an oil embargo, which caused oil prices to quadruple overnight. Inflation remained a persistent issue, so the stock market crashed again. This time it dropped 52%. What did Buffett do in these 2 crises? He did nothing. Yeah, you heard that right. He did nothing. In the second half of 1969, he closed down his company, Buffett Partnership. During the V-shaped rebound to 1970, he did not buy any stocks. Looks like he saw that something will happen in the near future. Similarly, Buffett began accumulating cash in 2005, long before the 2008 financial crisis. This time, Buffett continuously sells stocks. He must see something that we as individual investors don't see. Could another market crash occur in 2025 or 2026? We don't know yet, but we can always get ready by adjusting our investment habits. Now let's turn to a study conducted by Charles Schwab to see how we can improve our investing approach. Charles Schwab conducted a study on 5 different investment strategies in the S&P 500 over a 20-year period. The goal is to see how each strategy performed over time. These 5 investment strategies are 1. Investing at the market's lowest point each year. 2. Investing on the first trading day each year. 3. Investing at the highest point each year. 4. Use dollar cost averaging throughout the year. 5. Investing in the U.S. Treasury securities. Which investment strategy can yield the best result and which one is the worst? Obviously, if you are able to invest at the lowest point every year, you will make the most. Timing the market correctly every single time doesn't seem possible. The second place is to invest on the first trading day each year. This is achievable for all of us. The third place is dollar cost averaging. This is like you are constantly investing a fixed amount at regular intervals. It could be once a month. The process is automated. The fourth place is to invest in the highest point every year, which naturally leads to poor results. This is not easy to achieve, and it is not that smart to do. If you are able to identify market highs, it might be better to short the market rather than buy at the top. The last place is buying the U.S. Treasury securities each year. Of course, Treasury securities don't make as much as stocks in general, but they are safer. This is just one study, and market timing has its limitations. It looks at a 20-year time frame, but each 20-year period is different. The next 20 years is not likely to be the same as the last 20 years. What if the research picks a 10-year period? Would that be different than the 20-year period? That's possible. Regardless, timing the market is not achievable and impractical. So investing on the first trading day each year and dollar cost averaging are all easy to execute. We can see Buffett is timing the market because he has years of experience in managing a large amount of capital. What Buffett does in the current market can give us reference so that we can allocate our capital strategically. Here are 4 strategies we can safeguard our assets. Number 1, avoid panic selling. When the market crashes, many investors fear it is their last chance to exit, rushing to sell their investment as soon as possible. This is similar to buying stocks at the high point when prices are rising. These are emotional reactions. Our emotions should not move up and down as the market fluctuates. According to the research, 50% of the best stock market days actually happened in the bear markets. After a significant drop, the market often rebounds. Selling too early means missing potential gains from the recovery. Such opportunities are rare. So we should stay calm and think independently. As long as the company is fundamentally healthy and the moat is as good as before, or even better, then there is nothing to worry about. As long-term investors, short-term losses shouldn't be a primary concern. The economy is still growing, and the government has not stopped printing money. The high points we are seeing today could be a low point 10 years later. We need to evaluate how much risk we are willing to take. This includes how much mental stress you can handle and investment time horizon. Number 2, ensure proper asset allocation. Relying solely on a few individual stocks can be risky, especially during a recession. Diversifying your portfolio by adding ETFs or bonds can help manage risk effectively. Individual stocks are usually more volatile than ETFs, but the return is higher. Bonds are the opposite. Bond is a stable investment compared to the individual stocks. Of course, the return is much smaller. When the economy is good, stocks usually perform better than bonds. On the contrary, bonds have a better performance than stocks. As a result, bonds are a good investment to avoid certain risks. Besides earning interest, bonds have low volatility, and most importantly, their performance isn't closely tied to the stock market. It is wise to include bonds in your portfolio, with the amount typically increasing as you age. Number 3, keep dollar cost averaging consistent. Stock market crash may affect our emotions for days or even months. However, by continuing to invest steadily, as we have been doing, we can reap substantial rewards in the long run. Historically, the U.S. stock market has always trended upward. Regular investing allows you to lower your average cost by taking advantage of market volatility, ensuring you don't miss out on growth opportunities. During a bear market, your portfolio may show negative returns like everyone else. But when the bull market arrives, you will have over 30% returns or more. Number 4. Keep some cash on hand. While it may not seem like a traditional investment strategy due to the risk of inflation devaluing it over time, holding cash provides peace of mind. More importantly, having cash available allows you to buy more shares when the stock market dips, similar to Black Friday sales for stocks. This flexibility can be a valuable opportunity to buy at discounted levels during market downturns. Recession is unpredictable and unavoidable, but it is not too late for us to get ready for it now. Thanks for watching. Be sure to hit the like and subscribe button for more helpful tips like this. See you in the next video.